Unless you've been living under a rock, you will be aware of the recent conflict between Iran, Israel, and the US. And if you're retired or close to it, you might be feeling worried. But when you're still working, a market shock is a bad year. You wait it out, you sit on the sidelines, everything's fine. Your salary keeps on coming in. But when you're retired and time might not be on your side the way it once was, it feels like the damage is not always something you can recover from very quickly. This is exactly what we're going to talk about today. We're going to cover three things. So number one, what conflict does to inflation and why that hits retirees harder than anyone else. Number two, why a market drop during retirement is a fundamentally different problem than one during your working years. And number three, what you should do about it. Okay, so let's start with the one thing that's happening right now. Part one, what inflation does to a retirement income that it cannot do to a salary. Inflation is something everyone feels, but it does not hit everyone equally. And when you're retired, it is a fundamentally different problem than it is for someone who's still working. We're already seeing it with the current conflict that's upon us. Since the war began, global oil prices have surged by more than 25%. And as most of us know by now, oil impacts absolutely everything. For someone who's still working, that's just uncomfortable. And their salary is going to adjust over time. They might get pay rise, their pension contributions keep going in. They have a mechanism to keep up. When you're retired, that mechanism is gone. Your income's going to be largely fixed, whether that's a pension, a drawdown from your portfolio, or a combination of both. It does not automatically rise because the cost of living has. So when inflation picks up, as it historically does during periods of global conflict, every percentage point it rises is a percentage point your money buys less with. And unlike someone still working, you cannot simply earn your way out of it. This is why inflation is one of the most serious financial risks that retirees face. And it's the one that conflicts have historically made worse. But inflation is not the only way a conflict can damage a retirement. There is a second way conflict damages a retirement that's less obvious and in many ways way more serious. Part two, why a market drop during retirement is a fundamentally different problem than one during your working years. When you're still working and markets drop, you wait. Your salary keeps coming in, time is on your side. When you're retired, you do not have that luxury. You need money every month. So you have to sell down when markets have gone down. You're selling at the worst possible time, and when markets recover, you have less left to recover with. This is what's called sequencing risk. The timing of a bad year matters as much as the bad year itself. And it's why a market drop during a conflict is not just uncomfortable for retirees. For some, depending on where they are in their retirement, it can do damage that is very, very hard to recover from. Which brings us to the most important part. What should you actually do with your portfolio when there is a conflict? So part three, what to actually do. We've covered what conflict does to inflation and what it does to your portfolio if you're drawing from it at the wrong time. Now, the part that actually matters, what should a retiree do when a war breaks out? And it's probably less than you think. But there are a few things worth getting right. The first is the most important. Do not make reactive decisions. Every major conflict in modern history has triggered the same pattern. Markets drop, retirees move money, markets recover, and the people who moved are left worse off than the ones who just sat in the market and stayed the course. The data on this is consistent across decades of market history. The retirees who get hurt during conflicts are almost never the ones who stayed invested. The ones who got hurt are the ones who acted on fear. The second is your cash buffer. If you have enough cash set aside to cover your living costs for a meaningful period of time, you never have to sell anything at a bad moment. Markets can be falling, headlines can be terrifying, and none of it forces your hand because your day-to-day life is not dependent on what markets do this week. That buffer is what removes the emotional pressure that leads to bad decisions in the first place. And we recommend anywhere from 2 to 5 years left as cash, dependent on how cautious you really are. The third is your income. Conflict drives inflation, and we've covered that already. So the question worth asking is, can your income actually withstand a sustained period of higher prices? Not only this year, but over long periods of time. If your retirement income is entirely fixed and inflation runs for 2 or 3 years, which historically it can after a major conflict, that gap between what your income is and what your life costs get wider and wider every year. The fourth is your plan. Most retirement plans are built for normal conditions. A conflict is far from normality. It moves inflation, markets and currency all at once. So if your plan has never been stress tested against a scenario like this, if nobody has ever sat down with you and asked what happens to your retirement if all 3 of those things happen simultaneously, then now is the time to have that conversation. Not just because there's a crisis, but because that is what a good plan is supposed to do. The reality is there's always going to be another conflict or issue. The question is never whether something like this will happen again. It's whether your retirement is built to handle it when it does. War is frightening. And when you're retired, it can feel even more personal and close to home. But the retirees who come through moments like this are the ones who had a plan that was built properly. A cash buffer that meant they never had to sell at the wrong time, and an income that could hold up against inflation. And most importantly, an advisor who had already thought through what happens when the world seems like it's ending. This is what good planning should be. If you'd like to understand how your specific retirement holds up, the link in the description will connect you with a regulated planner who can talk you through it. Thanks very much for watching, and we'll see you in the next video.